Meta Platforms, Amazon, Qualcomm, UiPath, and CoreWeave. These are 5 AI stocks I think are undervalued. Let me show you why I think they're undervalued. So I've created a proprietary discounted cash flow valuation model that calculates a fair value of every stock that I'm interested in. My calculation for Meta Platforms shows that this business is worth $867 per share. The current market price for Meta Platforms is $648 per share. So my calculation suggests that Meta Platforms stock is undervalued. Now, you might be thinking, isn't Meta Platforms spending too much money developing artificial intelligence? Isn't that hurting the company's free cash flow over these next few years? And the answer is yes, it is hurting their free cash flow over these next few years, and I've already incorporated that into my calculation. You can see here from 2025 to 2026, I've incorporated Meta Platforms' free cash flow declining from $69 billion, which is estimated for 2025 when the year is completed, when the company reveals their financial statements for the full year. They're estimated to have earned $69 billion in free cash flow. I estimate that this will decline to $25 billion in 2026. So a $44 billion decline I'm estimating. In 2027, I don't expect the full recovery, only an increase to $39 billion, which will still be below the estimated $69 billion it earned in 2025. So I'm already incorporating a decrease in the company's free cash flow over these next few years because they will be spending so much on developing their capabilities in artificial intelligence. That being said, there's another factor I incorporated into my valuation, and that's the company's changes in capital structure. You may have heard Meta Platforms is borrowing tens of billions of dollars to build these data centers optimized for AI. They don't need to borrow that money. They're choosing to borrow that money. Meta has plenty of cash to build out these data centers. But when they're borrowing this money, that decreases the company's weighted average cost of capital. So I want you to pay attention to two things here in my valuation. You can see the cost of debt here, and what you see 0.055. That means Meta Platforms can borrow money at a relatively low interest rate, especially because the company can deduct interest expense from its income to lower its tax expense. And so the after-tax cost of debt is relatively low for Meta compared to its cost of equity, which is the line you see below. CAPM is the model I use to evaluate the company's cost of equity. It's the capital asset pricing model. It takes the risk-free rate and it adds the beta of the company multiplied by the market risk premium. And for Meta Platforms, its cost of equity is 11.84% as I calculated, more than twice the level of its cost of debt. So as the company borrows more money, it lowers its overall weighted average cost of capital because the cost of debt is much lower than its cost of equity. And the cost of capital, that's the rate I use to discount the company's cash flow, which is expected between today and the very long run. And the reason why we need to discount those future free cash flows is because money in the future is worth less to us than money today. It's associated with risk. It's associated with the time value of money. So you need to discount those future cash flows. So I know my audience is smart, and I know the next question you're probably asking is, well, then if the cost of debt is so much lower than the cost of equity, why doesn't Meta just finance the entire business with debt and use zero equity? Good question. And the answer they can't do that is because the cost of debt is low now, but it's not permanently low. Just like an individual, if you make $10,000 a month in income and your debt is $1,000 per month, you can borrow at low interest rates. But if you start to borrow too much money in excess of the amount of money you're making in income, then your lenders will not be willing to lend you money at those low interest rates. It's the same for a business. Right now, Meta can borrow at low interest expense, but if it takes advantage of that too aggressively, then its cost of debt will rise. So that's what the CFO gets paid the big bucks to do, to optimize that weighted average cost of capital, to find that right balance to get that lowest possible weighted average cost of capital, which I think Meta is doing an excellent job. The last thing I'll add about Meta Platforms is that all this spending on AI data centers are helping the company generate more revenue, make the user engagement more accessible, more exciting, bringing users back, adding new users, and engagement is increasing, revenue growth is increasing. Secondly, it's also improving the return on advertiser spending because they're able to use their AI to target advertisements more effectively, generating better returns on the money that marketers are spending. And since the company generates nearly all of their revenue from advertising, it's helping the the company improve revenue in that way also. So all this spending is going to return better investment on investor capital, which is good for long-run returns for this company. Amazon is the next company I highlighted as an undervalued AI stock you can buy. The intrinsic value per share I calculated for Amazon is $270. The current market price is $247. By the way, if you want access to these proprietary financial models and discounted cash flow valuations, you can get access to all of my DCF calculations if you join my channel as a member at the investor tier or above. So just like Meta Platforms, Amazon is spending aggressively building out their data centers optimized for artificial intelligence, and Wall Street is skeptical that this will return good returns on invested capital. Now, I've been following Amazon for a long time, and the management team has done an excellent job allocating capital. So I have a reasonably positive expectation that the current spending on artificial intelligence from Amazon's management team will also result in a good return on investor capital, since this management team has generated a history of being good, effective allocators of capital. Amazon has already demonstrated improvement in its business as a result of the increasing spending on artificial intelligence. The company's most lucrative AWS segment has reported accelerated revenue growth, and the backlog, the remaining performance obligations in this segment, is also increasing by the tens of billions of dollars. The next stock I highlighted as an undervalued AI stock you can buy is UiPath. I calculated an intrinsic value per share at $21.88. The current market price is $17.33. UiPath is at the crossroads of artificial intelligence and automation to make business processes less costly to perform. UiPath helps enterprises more efficiently operate their businesses. And since the cost of labor has increased so substantially over the previous 5 years, their services are more highly sought after. UiPath stock faced some turbulent times when the founder turned CEO retook the job as CEO, forced out the previous CEO, and investors were concerned about the abrupt change in leadership. However, since then, Daniel Dines, which is the founder, now CEO, has demonstrated excellent improvement in the business, improving the company's revenue growth, its annual recurring revenue, keeping costs under control, and convincing investors that he knows what he's doing at the helm of the company. The next stock I highlighted as an undervalued AI stock to buy is Qualcomm. The intrinsic value per share I calculated at $200. The current market price is $169. Qualcomm has done an excellent job expanding into new market opportunities. Qualcomm is known for having a large market share in the smartphone industry, and one of the things that's benefiting Qualcomm in the smartphone industry is the trading up activity. People are buying relatively the same amount of smartphones this year compared to last year, or I should say in 2025 compared to 2024, with low mid-single digit growth in that industry. But what did happen in 2025 compared to 2024 is people were buying more premium smartphones. And one of the main reasons because of that is because people wanted smartphones that were more capable of deploying some of these new AI features. And so the price per unit of these phones were increasing because these smartphones were embedded with higher technology, with more components that generate better effective use for these smartphones, and people were willing to pay those higher prices. That benefited Qualcomm. Qualcomm has also demonstrated an ability to expand into new markets effectively. Its PC ambitions are working really well. Its Snapdragon software and components going into personal computers are demonstrating that the company is gaining market share in that new industry. It's also gaining market share in the automotive industry as more and more cars are being embedded with more and more technology. Not just driverless car technology, but also assisted driver assistant systems, adaptive cruise control, lane change assist. All of these features that are going into vehicles require more components, more enhanced technology, and that's also benefiting Qualcomm. Its automotive segment is growing much faster than its smartphone segment. CoreWeave is another AI stock I recommended as an undervalued AI stock you can buy. The intrinsic value per share I calculated at $103. The current market price is $91. CoreWeave helps companies by building data centers optimized for artificial intelligence and renting out that compute capacity. So this helps companies like Amazon, Microsoft, Alphabet, and others like Meta Platforms that don't want to own all of their AI data centers. Sometimes they want to own some of their AI data centers, and sometimes they want to rent some of that computing capacity. It helps enterprises manage their computing costs. It helps them offset some of the risks. They don't want to own all of that. And CoreWeave is developing skills in developing these data centers cost effectively, building relationships with companies like NVIDIA, which is the core accelerated computing chip that's making all of this possible. So CoreWeave is a core element of this increasing demand for artificial intelligence. And the last thing I'll say about CoreWeave is the company's management team has reiterated several times that demand for its products and services exceeds supply. And that's the case for many companies that are operating in this industry. Demand for artificial intelligence exceeds supply. CoreWeave is helping to balance that by building more supply. Now, the downside, the risk here is that, of course, throughout history, whenever you've had shortages, which is the case right now for AI, it's followed by gluts because the building comes in so aggressively to match that demand. All of these companies want to meet that demand for artificial intelligence, so they're building, and there's a risk that there might be oversupply. But the productivity enhancements that's being driven by these AI spendings will result in its own positive virtuous cycle. As demand creates an increase in supply, the increase in supply makes every employee more productive, which then creates its own demand, which then creates its own supply. And I see that positive virtuous cycle extending for at least another 2 years, perhaps even longer than that. So there you have it, 5 undervalued AI stocks you can buy now in 2026. One, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.